trying to prove it wrong and show how bad it was. But when you start looking at all the stuff that all these haters are saying, you start fact checking and actually learning how it works. All of a sudden now I'm like one of the biggest endorsers of Index Universal Life.
Hey everyone, Dustin Wiley, CEO of Viking Financial, CMO of Spectrum Planning Group, and welcome to this non-biased financial podcast where we bring in industry professionals across the board. What's up, guys? So I got Bryan Jarrell here. He was the first person to really spark my enthusiasm for Index Universal Life Insurance. It's been a long journey since we have met, and I'll tell you that Bryan is probably the foremost expert that I know on Index Universal Life Insurance policies. To this day, he still blows my mind how he knows things about the option contracts and everything for these policies. So I'll just let Bryan jump in. Hey, where'd you come from? Who are you? What's your knowledge base? Just let it rip.
Yeah, I been doing life insurance. I got licensed in September of 2019. Took a really big interest in cash value life insurance probably during COVID. Realized that mortgage protection and final expense just wasn't for me personally. Didn't see the value added when you find out that 1 to 3% of all term policies pay out. Kind of lose a little excitement about it. I get it. It has its place, and I personally have a term insurance, so all those term haters don't hate me too much. Still like term. I do believe it has its place, but I really got into cash value life insurance, and it just blew me out of the water. First started learning about whole life participating plans, and then I was a hater of IUL, and then all of a sudden I started looking up more stuff to counteract those IUL agents. And next thing I know, I went to the dark side and started learning about Index Universal Life, trying to prove it wrong and show how bad it was. But the number one thing I came across was what makes an IUL bad. All the same stuff that all the haters out there are saying. Fees are so high that they eat up the policy. Well, guess what? If it's structured right, it's not an issue. You got to pay money to borrow your own money. No, if you understand how a variable or alternative loan works, you're never borrowing your own money. You're borrowing somebody else's money. So when you start looking at all the stuff that all these haters are saying, you start fact checking and actually learning how it works. All of a sudden now I'm like one of the biggest endorsers of Index Universal Life. And it's what I've noticed is over the time is majority of people just don't understand the product. There's so much ignorance on the topic, and I understand it because I mean, Dustin, how long did it take to really learn it? You know what I mean? 3 months, 6 months, 9 months. And I still don't even know everything to know about IUL, but it's like I've been doing this for 2 years at a pretty high pace, doing nothing but learning, and I still don't know it all. So it is a very complex product, and I can understand why, people feel like they need to hate on it. But again, if you don't know what you're talking about, just leave it be. Stop passing misinformation, telling people that they don't get their death benefit and their cash value and stuff like that. Number one thing that I found, and I'm sure you can attest to this too, is people always say the cost of insurance gets so high that it eats up the cash value. Now you got nothing left, so now you leave nothing behind. And that just kind of goes to show that people really don't understand net risk. And for those viewers who don't know what we're talking about with net risk, what that means is there's 3 things to a contract, guys. There's your cash, there's your net risk to the insurance company, and there's your net death benefit. See, when these things are set up properly, what we got to do is make sure we're getting the smallest amount of life insurance the IRS physically forces us to get, which is referred to as net death benefit. One of the cool parts is the IRS actually allows us to count our cash as a portion of the death benefit. So if, for example, we want to put some money into a policy and the IRS comes out and says, hey, we need a $500,000 death benefit, the truth is, day one, we really don't have any cash in. So if we die, who pays out the death benefit? The insurance company. We're paying for $500,000 of insurance. But as we start putting the money in, now we've got $100,000 of cash growth. Whether you put the money in or the money grew to $100,000, it's irrelevant. We don't have to. We still got to have $500,000 of net death benefit to the IRS. But guess what? 100 of it's our cash. We're only paying for $400,000 of cash value life insurance. Therefore, we're buying less insurance. So yes, it does get more costly as we get older, but if we buy less, we're able to control those costs. And that's the number one thing that most people don't understand. They'll say, oh, you don't get your cash plus your death benefit. Yeah, you do. You get the cash plus the death benefit you're working with. That equates out to the net death benefit. And that's where the Dave Ramseys and the Prime America agents and stuff like that are always saying stuff like that you don't get both. And it's factually incorrect. What's been kind of your take on it, Dustin?
Man, I keep hearing level's the devil. Level, you don't get the cash value. So if you can just kind of talk about how level works and how you do have that net amount of risk, even day one, all the way up to whenever it does switch to B and it starts to increase with the cash.
Yeah, so the biggest thing is, like you say, level is the devil. That's the worst thing I've ever heard, because every policy, folks, should go to level at some point or not. All level means is we're allowing our cash to count as a portion of the net death benefit. Now, where it gets funny is, again, every policy should have that. So whenever I see a policy that stays on increasing for life, that just kind of tells me, hey, this cost of insurance is going to get astronomically high. Now, what was the other question, Dustin?
How your net amount at risk actually goes down even with level. So like if we do a 10 pay, starts off level and it ends level, the net amount of risk gets less because our cash grows, right?
Yeah, that's exactly what it is. So if it's on an increasing death benefit, what level is doing is, again, counting your cash as a portion of the death benefit versus the increasing death benefit. Oddly enough, this is kind of the irony of it, is a level death benefit is actually a decreasing death benefit, and an increasing death benefit is really a level death benefit. On an increasing death benefit, you're saying, hey, give me the same net risk that we've always had. So if you have an initial death benefit of 250,000 and you're on an increasing death benefit, you're saying keep me with $250,000 of insurance forever. Well, guess what? Biggest downside to IUL is costs get higher as we get older. So if you're keeping that same 250,000, it's a lot more for an 80-year-old than what it is a 30-year-old. So again, we want to shift that net risk by switching to a level. Now, the reason we use increasing is so that way simply we can continuously fund the policy. Because if we start with a certain death benefit and we want to continuously contribute, like on a 20 pay or a 30 pay, you got to make sure that you're on an increasing death benefit, switching to level in the year you're done funding. So again, majority of the time is just people just don't understand what they don't know. And everybody's an expert until they're not.
Man, the biggest thing I see on social media with the Primerica, all these trolls are the fees. So let's talk about fees. Dave
Yeah.
Ramsey says the fees are 10% in the first 10 years, and that's all he says. He doesn't say that over a 30, 50, 60-year IUL policy, you could net a 0.5% in fees. So talk
Yeah.
about fees a little bit, what you've seen and how you should structure a policy to get the right fees.
So number one thing is with fees, you got three different fees, guys. You got your premium load, you got your per 1,000, and then you got your cost of insurance. If you're putting money into the policy, guys, it's no different than if you were to go to the grocery store and spend $100. There's a portion of the money that the grocery store is not going to get to keep. That's the merchant fee. So every time you put money into the policy, there is a merchant fee that they're going to take. You can, once you're done funding, that's going to go away. Now, the other fees that can be alleviated by the agent is if they're willing to set up the contract properly. In other words, minimum death benefit, max cash accumulation. What that's going to do is it's going to lower two things. It's going to lower your cost of insurance, and it's going to lower your per 1,000 fee. Those are the most paramount things to be done right. Is you got to make sure the policy is structured correctly, guys. It needs to be solved off the guideline premiums, not the target. Target is what we get paid on, and this is the number one thing we see when we're auditing these policies is it's written at target. It's to maximize the agent's commissions, not the clients. So hopefully that wasn't too much of a long-winded discussion on that, but it's just something we come across. Dustin, what really bothers me, I guess, is I've done over 400 policy audits, and I've come across 11 done. So it's really hurts to see like all these people pushing IULs and stuff like that, and they don't even know how to properly structure it. So it's just been awesome to be able to help people to be able to do it right. And that's one of the biggest things that we just got to fix in this industry.
Man, I'm glad you brought that up with the auditing because I was going to ask that next question, but you already squashed that. So I've audited, I've done more first calls and second calls than auditing, but I'd say I've audited maybe 50 policies and 3 were done correctly. So about the same ratio. I mean, your ratio is a lot worse than mine, but 50 done, 3 right. And of those 3, I've actually recruited 2 of those people. So if I can go find people that are going to do it the correct way, I'm going to put them on my team all day long.
Yep.
And I'll tell you, a lot of people in the industry say, oh, your close rate is 4% or 8%. That's not good. Well, let me tell you why I have a 4% or 8%, because I turn people down. If they tell me they have $500 a month and they're 40 years old and that's all their leftover money at the end of the month, It does not need to go into an IUL. They need some kind of emergency fund. They need to fund their 401k up to the match. I've turned people down. Now, if I was like everyone else and I closed 80, 90% with trash policies that are probably going to charge back, man, how many seven figures I could have made this year. So I'm glad to see or know somebody that sets all these policies up at 7702. And that's another thing, 7702. So that's like Chinese people. Explain 7702 and how it works.
Yeah, what the 7702 tax code does is basically kind of defines an insurance contract, because you guys got to remember, investments are taxed, life insurance isn't. So it used to be that you could throw any amount of money into an insurance policy and it would just grow tax free. Well, the IRS was like, hey, you guys are just manipulating the system here, so we need to put a definition in. So what it did is it basically defined that we need to have so much insurance per dollar put in. Now, this isn't exact, but it kind of gives a ballpark figure of how it works. Is all the way up until 2020, when so all these laws came out basically in 1982 and 84 during the TEFRA-DEFRA. And what it did is it defined the difference again between the insurance versus the investment. And it used to be that if you had $10 to put in, you were allowed to put $7 towards the cash growth, as long as $3 went towards the cost of insurance. Well, lo and behold, something amazing happened, and Congress passed something on January 1st of 2021, which was they adjusted the 7702 code. So now they're allowing you to put $9 towards the cash growth and only $1 towards the cost of insurance. Well, lo and behold, what grows more, $9 or $7? So it really sparked an interest and really took cash value life insurance off. That's why you're seeing all these TikToks, all these Instagram stuff like that, going in marketing because of that, but they don't structure it right. What they're doing is they're structuring these policies. They're saying, hey, Dustin, you got $10. Let's go ahead and put $5 towards the cash. And let's put $5 towards the cost of insurance, because now they're getting paid on $5 instead of one. And this is how you end up with 400 plus audits and only 11 being done right, or in your case, 50 with only 3 being done right. It's just an absolute pandemic the way it's been going, but that's basically the easiest way that I can sum up the 7702.
Yeah, there's two things I wanted to talk about. So social media, you brought that up. There's a lot of gurus on social media now, a lot of people that only push IULs. They don't talk about fixed index annuities. They don't talk about taking the match to 401k. I personally believe these guys are FFL, WFG, PHP. I probably shouldn't be saying their names. Those guys that are able to now post on social media. So I know for a fact a guy in one of those industries said that they will not allow you to have social media and market life insurance or cash value life insurance or annuities or anything in general. They would not let you do it. Well, about a year ago, when their top dog left and created his own IMO, they said, oh, he was doing social media marketing, we're going to do it anyway. So now they allow it. So the reason why you're seeing this bombardment of people on social media acting like they know what they're talking about is because they're now allowing them to go out there and do that. Now, I've seen these people's illustrations. Some of the audits I've done I'd say I've done a lot of audits, but it's on illustrations. These illustrations are showing target across the board. Target meaning, if anybody's listening, if you put $1,000 a month into an IUL and you're 50 years old, your target, if you max fund for target, we're talking $12,000 commission. Your whole first year that you put in every dollar goes into my pocket because I set it up wrong. Now, if I was to max fund it at a 50-year-old, we're talking like $2,500, $3,000, something like that. And you could really blend it down to $1,000. So what we're trying to say is I can make my commission as small as I want and as large as I want. So to just go out there and let your cousin set it up, this one guy that has 300 followers that talks really, real nice, like he's saying the right things, he's tickling your ears. You can't do that. You really have to do your due diligence. I mean, I've had people say, I didn't know that you sold these policies. So I went to so-and-so, can you look at my new policy that I got? And it's funded at target. And they put $50,000 in up front with $500 a month after that. So another thing, talk about front loading and how, when should you front load? When shouldn't you front load? And what is your absolute max?
The simplest way to put it too, guys, the biggest red flag you should be looking for is, do you have any surrender value in year one? If you have a big fat goose egg and it says 0 in year one, you have a messed up policy. Please get it audited. It's very important that you guys understand that. If you have 0 surrender value in year one, it means your policy is done inaccurately. You should have anywhere between 40 to 80% of the premiums you put in, depending on your age, insurability, and stuff like that. So very important to understand that from the get-go. And then, sorry, our short-term memory. What was the question?
Oh, hey, same thing here. So when you're funding and you're trying to put in a front-loaded policy, what's the max front load? What's the worst you've seen? Like, when should you stop on the front load?
Yeah, I see it a lot of times where inexperienced agents that don't understand IULs. What typically happens is they're front loading it as if it was an annuity. So if a client comes to you and they say, "Hey, I got 100 grand," they're throwing the 100 grand in day one. And unfortunately, to be able to for the 7702 tax code with TAMRA on the Tax Miscellaneous Revenue Act of 1988, for it to be a non-MEC or to adhere to the 7-pay, there's so many different terminologies, I don't know where to go. But for it to be a non-MEC policy, what happens is the death benefit has to go up super high to be able to accommodate that 100,000 per year without becoming a taxable event. Now all of a sudden you start running into issues. So whenever I front loaded, I like to use a general rule of thumb, and it's basically 1 year per decade. So if you got a 30-year-old, we're going to put that 100,000 in over 3 years. If you got a 50-year-old, we're going to put it in over 5 years. If you got a 70-year-old, we're going to put it in over 7 years. So that's traditionally how I do any front loaded like strategic rollouts or anything like that.
Sweet. So whenever we first met, I was in the same boat of what you talked about, where you were doing final expense, term insurance, a little bit of participating whole life for debt consolidation and IBC. And then whenever I came across you, we did this like hour and 20-minute presentation, blew my mind. Like there was so much information. I went in the room with my wife and I was like, my life has changed. I am strictly getting away from everything but this. But
Yep.
anyways, long story short, you blew my mind with all that knowledge. If there's agents listening to this, which I believe there's going to be more agents listening than actual clients right off the bat, how do they get a hold of you? What do you do? I know you host a weekly Zoom call, kind of just give people your contact information and what you do so they can find you.
Yep. So my name is Bryan Jarrell. I'm a Smart Advantage Growth Alliance. You guys can go to smartadvantagegrowth.com. That's our website. We have a Facebook group. It's called Cash Value Life Insurance Done the Smart Way. I do a weekly training every Wednesday, 12 p.m. Pacific Standard Time. I go on there and do this stuff so that way, there's two types of agents. I always say, guys, we have the greedy agents that know better and still do wrong. And then we have the ignorant agents like myself. I didn't know better. So what we're trying to do is cure up all that ignorance. We don't want ignorance to be an excuse for poorly designed policies. We'll leave that just to the greedy ones. So you could go to Facebook, type in Cash Value Life Insurance Done the Smart Way. There's a big banner. It says 7702, looks like a comic strip. That'll be our group. Feel free to join in. And I post the links every day, every Wednesday for the call. And then I typically put in the live recordings too. So there's a whole library. You guys can go back and learn some of the older stuff as well.
Okay. So like as a bonus real quick, there's a lot of good guys out there in the industry. David McKnight, Doug Andrews, but a lot of them kind of choose one side or the other. How do you feel about leaving some things off the table versus on the table? So today I'll give you a quick example. Personal Finance Club got into one of my clients' feeds. They saw something about, do you want to lose $1.5 million? Start an IUL. Basically what it was is, about 2 years ago, he started an IUL policy with an agent that just started. So they funded it at Target, had no clue what they were doing. So
And
that's the
minimum
video that he
funded.
keeps posting. And minimum
And
funded,
minimum funded.
$200 a month for a 40-year-old.
40-year-old. Huge red.
Exactly. Exactly.
General,
So
you need to get, just sorry to cut you off, Dustin, but this is very important for you guys to know. Minimum funding for a policy is traditionally 10 times your age. So for a 40-year-old, that policy needed to be funded at least $400 a month. So we know right off the top, even if it was properly written and properly structured, his death benefit is already 2 times higher than what it needed to be, period. So, and written at Target, policy was doomed from the start.
I guess I say all that to say, do you agree that we shouldn't leave things off the table? That you shouldn't just go in and say, hey, the IUL is the best thing in the world. Stop funding your 401k. Stop putting into a Roth.
No, I'm 100% on. A Roth I can make an argument for, because they're both post-tax dollars. One has a limitation, one doesn't. But I'll tell you what, with the 401k match, guys, you can't beat that. If your client's getting a 6% match, I'm going to tell them, hey, keep doing that. It's free money. There's no way I'm going to ever do that. On a Roth, like I said, you could make the argument for it. You get a little bit better liquidity. You're not held down to 5 years and contribution limits only. And then you get the leverage to the IUL. So a Roth I can definitely make an argument for. But I can definitely, see why people do it as well. There's nothing wrong with
the Roth.
diversification.
To me, the Roth 401k with a Roth match, now that they passed the new bill,
Yep.
like take
That's
that
different.
all day.
Yep. When you hear the word match, folks, match is free money. If I gave you $50 and told you to go to the casino on my money, how quickly would you do it?
Exactly. Well, man, I appreciate you being on. This was really quick. I want to have you on again. We're going to get it a little bit deeper. I'd like to have like a training session that we could put on here because I know, like I said, there's going to be a lot of agents on. But
Yeah.
besides that, man, I'll let you get back with your work day.
All right. Thank you so much. And you have a good one. It was nice meeting you guys all. All right. Bye now.
Remember, guys, this podcast, this show, this Instagram post, wherever you found this, will go nowhere unless you like, share, comment, subscribe. And remember, we are taking on new clients, and our lowest income is about $20,000 a year, highest around $1 billion. So most likely you fit the bill.